Hey guys, welcome back to another edition of the Market Preview. My name is Vasily, I'm a trading coach and professional forex trader. For today I have prepared for you a lot of education. I think you noticed that right now the market is very volatile. All the pairs just keep rallying and it's so hard right now to catch a nice trading opportunity. If you caught the wave from the start, you are a lucky guy and you just keep trailing your stop, but if you try to jump in, if you try to catch the counter trend movement, man, it's so hard. And here, by the way, I opened for you the dollar chart, dollar index chart. And who would imagine that during the time of crisis, the dollar value would drop so huge? Dollar lost 6% of its value from March, and it's just crazy. I'm very long biased on dollar, and I believe that in such bad times people just buy dollar because, well, what else to buy? Not Russian ruble, I think. But dollar drops and we should be prepared for such situations. So I will show you how to survive the high volatility. I will show you how the very simple technique that will help you to avoid losses trading the structure, trading the key levels, and we will discuss a lot this kind of examples. And moreover, I prepared for you an example of trading the patterns on a higher time frame. So I will show you how to correctly trade the big pattern, very big pattern on a daily, and how to properly set stop for such kind of patterns. So enjoy this video. Don't forget, as always, to like it. Don't forget to subscribe and share it with your friend, because so nice channel, guys. Let's start. So I want to start with the euro-yen pair. What is particular about the euro-yen pair is the very crazy bullish movement that happened during the last few weeks. You can see how strong bullish movement we had, and it's just lucky are those who just caught this movement from this 114.45 level. It is just so exceptional movement and so many pips can be made here. But also what we should pay attention to here is the key levels. So let's just analyze the key levels that the market broke, and try to get what happened with the market based on that levels. So here we're going to start with that level. We just analyze the daily time frame and we just pick the historic levels, the levels from which the market reacted in the past, from which it dropped in the past, and based on which we saw a strong bullish or bearish movements in the past, right? So for that reason we pick this level first. Obviously in the past, from that level the market started a very strong movement, so we definitely consider this to be a key level. Next level is here, this next structure level. Yes, and once again you see how many times in the past the market reacted to that level, and this is also a key level for us. Now we go even higher, and here we have the next key level. Very important level, and as you can see, so many times in the past market participants respected that level, and we saw nice movements from that. Yes, so we have really a lot of key levels on euro yen. They are lying very close to each other. They lie in a very harmonic distance between them. You see that the distance between these key levels is almost equal. So very nice sequence of key levels. And here is the point. I know that many of you are trying to trade just the key levels. You are trying to identify a key level, and once you identify the key level, you just place the limit order, or you just enter on spot and you just short it with the stop just above the level, and you aim at you're looking for a drop. And you want to catch the movement from a key level. So as you can see, following just this structure, following just this strategy, trading euro yen, this time 1, 2, 3, 4, 5 times in a row, your strategy would just fail. Your strategy would just fail, and it is not because you incorrectly identified the key level. These are truly the strongest key levels, especially that one, especially this high of 2020. It is just so exceptional level, and I also expected a bearish reaction from that. But as you can see, if you just trade the key levels, if you are not looking for something else, this strategy would fail. And if you just go through the main forex pairs, the majority of them just look like that. They all just look like that. And if you would trade the strategy, you would just wipe out all your deposit. So let me tell you the very simple approach that would help you to avoid losses. So the very simple thing that I do now, I just switch to lower time frame. I switch to lower time frame on 1 hour chart, and on the 1 hour chart, a very simple thing that we do is just we analyze the reaction of the market on a key level. So we're gonna start with the lowest level that we identified, the lowest resistance that we found, and that the market has easily broken. So what is important about the structure? What you should pay attention to right here is the price action. So here is your bullish wave, yes? Here is your bullish wave. And once the market reached that key level, the market started to form a very popular reversal pattern, the head and shoulders pattern. But what happened with this pattern? The market just violated the head level and went higher. No breakout of a minor structure, no breakout of a neckline. So we just don't trade. It is the signal for the trend followers. Trend followers buy from this level. This greedy bastards just want to jump in this bullish movement. They see that they missed this wave, but they want to jump in and use. So they just try to buy from this minor support, and this time they just won. You can see that how strong bullish movement we had, and if only the market would break the neckline to the downside, then it would be the signal for us, then we would short. But here just no signal. You see the reaction of the market on the lower time frame on that key level. It just shows that not enough selling pressure to go down, that we just should not trade at all, right? Yes, so this is the reaction on the first level. Then we go and we analyze the reaction on the second level, and here is quite funny. Look at the price action. Here the market reached that level, right? Then it retraced, then it tried to test it the second time. Yes, here it formed very nice double top, broke the minor support, and here I shorted, and here I sucked. Here in that example, my confirmation approach failed as well. I sucked here, so here, no matter what strategy you trade with the counter trend, you would suck anyway, I think. Let's analyze the next level. Next level here. Once again, price action. The price here forms the head and shoulders, right? It is trading on the neckline, multiple tests of the neckline, and you see that the trend line is still respected. And once again, this greedy bastards, these buyers, they keep buying, and boom, once again bullish movement. So here, confirmation approach, the reaction on the 1 hour chart helped me to avoid this short trade. But if you would just trade the key level, it would be a loss for you once again, right? One more time, I mean. And here the next test of the key level. Once the market tested that level, rejection, the market dropped, and here we had a very nice foundation for the potential double top pattern. But once again, the minor structure is respected. Greedy bastards buy, and once again bullish movement to the upside. No minor breakout of structures. So with the checking the reaction of the market on the lower time frame, once again we would avoid this loss, right? We would avoid loss based on that level, but if you trade just this structure, it would be a loss for you. And last key level that we identified, once again you see the market try to test that, retraced, and then just new high, new bullish movement, very strong bullish momentum candle. And once again, no confirmation on a lower time frame, no reversal pattern, no breakout of a minor support. The market just keep growing, right? So let's conclude the difference between just the structure trading and the confirmation approach and the reaction checking on the lower time frame. So let me one more time show you the key levels that we have identified on Orient chart. Here we have 5 key levels, 5 key daily levels, and here if you trade the Orient pair just on the daily time frame, and if you decided to short just from this key daily levels, the point is that you would have a losing streak of 5 trades. So if you would risk just 1% of your deposit per trade, as you can see, you would have 5 losers in a row, so 5% drawdown of your account. But if you just simply check the reaction of the market, if you would look at confirmation on a lower time frame, you would just lose 1 trade. Yes, you would just had a 1 losing trade and 1% drawdown of your deposit. So just patience and just one more layer of analysis will dramatically change the performance of your trading. So next time when you trade the key levels, don't be lazy, just just watch the lower time frame, open the 1 hour, 4 hour, and just see how the price action goes there, and then just act. And just adding this additional layer would so dramatically increase your trading. And just try to do that, guys. Just try to do that and just let me know how it works for you. So now let's discuss the next financial instrument. So one of the most common questions that you ask me in my YouTube videos in the comment section is the stop placement. So I noticed that for many of you, the stop placement issue is very important, and you are looking for a clarification on how to properly set the stop. So here we will discuss the example on the euro-pound pair. Here we have a very huge pattern that we will potentially trade, and I will show you how do I identify the top stop placement for that trading setup. So right now we are on the daily chart, and on the daily chart, as you can see, the price has reached a key level. It reached a key daily level, and for quite a while the price is trading on that level. And as you can see, we had multiple attempts to break above that level. So just recently we had the first attempt here to break above that, then the market retraced. Second attempt with the very nice rejection candle, and just this week one more attempt. So the price action looks like that. Bullish wave retracement, next bullish wave retracement, and here the next bullish wave. So it looks like it is the classic head and shoulders pattern, right? Here we have our clear horizontal neckline, and moreover, as you can see, this year this euro-pound pair is very bearish. From March we had a strong bearish wave, and now it looks like it's just a pullback before the second wave to the downside. So we are bearish biased here, and we're clearly looking for a signal for the trend following trade. So here we always look for the breakout of the neckline. We are looking for the daily candle close below the neckline to short on the retest, expecting the continuation to the downside, right? And by the way, talking about the targets, here we could have perfect first target for the trade, and then the next structure is here. So the potential reward for the trade is just huge, right? But how to set stop here? How to place our stop correctly? According to the rules, we should place our stop above the right shoulder. So if we just trade the setup, our position would look like that. And I think here for stop placement, it is around 125 pips. You know, too much, I think, and definitely trading so big trading setup, we don't need to place our stop so high. Here we will apply the lower time frame. We will switch to the lower time frame, and there, based on the structure on the lower time frame, we will identify the correct level for stop placement. So now I am on the 4-hour chart, and first thing that I want to do here, I want to remove all these drawings and just keep the neckline that we identified on the daily. It is the only thing that we need so far. So on the 4-hour chart, here is our neckline. It is currently the structure support for the market, and we are looking for its breakout on the daily to short its retest, because once it's broken to the downside, it will turn to resistance, and sellers will most likely sell from that, right? But how about the stop placement? Of course, setting our stop above the right shoulder is just too much. too many pips to lose, and we don't need to place our stop so high. So follow a very simple rule. When we trade so big patterns, when we trade so big trading setups, just identify the closest resistance to our neckline. Yes, so here's our neckline, and we are looking for the closest resistance on 4 hour. And here I think you can notice that here we just have a perfect resistance. Yes, perfect resistance level. And here we will place our stop just above that resistance. We will place our stop just above that resistance, and for us it's just no need to keep our stop higher. So just imagine the market breaks the neckline on a daily, then it retests, but after the retest it just goes higher, and you know, if it just goes higher, this neckline will just turn to support again, and the buyers will buy from that again. So no need for us to just keep holding. We just quit the trade and we don't hold, we just embrace the loss. And you know, with such approach, risk to reward for the trade would dramatically increase. So if we just take the risk to reward for the initial target, so here is our initial target for the trade based on the daily structure, you can see we have 2-to-1 risk to reward just for the initial target, and for the second target, risk to reward for the trade would be just huge, more than 5-to-1 risk to reward, right? So I hope you got the logic. Once we see a big trading setup for stop placement, we look for a minor structure on the lower time frame. We are looking for the closest minor structure, and we just place our stop above that. We no need to place our stop based on the daily structure. Enough just to find the minor one, and based on that, set stop accordingly. So try this example with the huge double tops on the daily, head and shoulders triangles, and I'm sure you will see how efficient this approach is, right? So next week, look for the daily candle close below this neckline, right? And if it closes below, try to trade this setup as I proposed and just see how it goes, guys. Right, guys, I hope you enjoyed this weekly edition, and as always, if you have any question, if you want to ask me something, always feel free to leave your question in the comment section. I always reply to all your comments, so if you need help, just let me know. Also, feel free to propose new topics for the next weekly editions, because I truly need your help, and you help me a lot with the selection of the topics for this market preview. So if you want more education, if you want more educational videos, I have a lot in my educational group. So if you want to join, just let me know. Links are in the description below. You can find me there, TradingView, Twitter, Facebook, Telegram. So many places to contact with me, so just do that. Thank you guys for watching, and like this video, subscribe to this channel, and good luck.